Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kessling, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Hey, what's up, everybody? Welcome to the Absolute Return Podcast. On today's show, we welcome special guest, Mirion Technologies CEO Tom Logan. Mirion designs, manufactures, and provides radiation detection, measurement, analysis, and monitoring products to the nuclear power and medical markets. On the show, we discuss the path from private equity ownership to the public markets, the macro bull case for the nuclear industry, Mirion's approach to mergers and acquisitions, his learnings as a long-tenured CEO, and more. So with no further ado, here's our show on the nuclear revolution with Mirion Technologies CEO Tom Logan. Hey everyone, welcome to the podcast. We got Tom Logan, CEO of Mirion Technologies, on the show today. Excited to discuss several topics, one of which is becoming increasingly popular in the eyes of investors. This is the whole nuclear renaissance and things of that nature, which, Tom, you can help us understand. But prior to getting into the specifics, could you please kind of go over what you accomplished 20 years ago, this three-way merger to form the business? What were you trying to create with Mirion, and really, what did you set out to accomplish?
I'd be happy to, Julian. My pleasure to be with you today. So, beginning back in 2003, our origin story, like many, is filled with twists and turns. But initially, the vision was that working with a private equity sponsor, that we would simply piece together three fairly disparate assets, and that had a kind of a loose correlation in the field of radiation detection. But recognizing that at the time, all of the major nuclear reactor designers were coming out with the then current third generation of technology, and there was a bit of a budding nuclear renaissance. And we smartly thought, if we can piece together these three assets, put a veneer of integration over the top, then we can enjoy a scale multiple expansion, do a quick flip, and be in and out of this thing in about 2 to 3 years. And that's how it began. And obviously, 21 years later, here I sit. So either something went very right or something went very wrong. But what was intended to be really a fairly clinical transaction, effectively, it's turned into my life's work in the form of Mirion Technologies. And in our view, and I'm happy to dig into this, we've created a bit of a unique exposure, not only to this burgeoning nuclear power industry, but also more broadly to cancer care and space exploration and many other things that are all tied together by a common thread, which is a technological thread. And that is that we are the world's leading experts in measuring, detecting, and analyzing ionizing radiation. And what we discover in any field, be it nuclear industry, healthcare, science, defense, is germane and relevant to everywhere that we play. And so as a company, we enjoy incredible technological leverage. We enjoy a rather large total addressable market that is $18+ billion and growing rapidly. We enjoy a position of brand dominance, being the global leader in 17 of our 19 product categories, being the largest play in our space. And of late, we're blessed with market tailwinds that, candidly, we've never had in our 21-year history. And so we couldn't be more excited about not only the future of nuclear industry, but the future of our company.
Very interesting. Now, prior to getting into the fundamentals, I did want to touch a bit more on the formation and the evolution of the business from a capital perspective, because the story is quite unique. So digging into the background, you mentioned initially effectively incubated by a private equity firm. And as far as I can tell, another private equity firm, Charterhouse Capital Partners, came in, then going public through Goldman Sachs blank check vehicle, GS Acquisition Holdings 2, and now you've been publicly traded on the New York Stock Exchange for 3 years. Can you talk about, access to capital? Have you always had institutional funding and these different evolutions that the business has gone through?
Of course. So recognizing that for 18 of our 21 years, we've been backed by private equity, two different firms. First one was a business development corporation, no longer in operation, called American Capital Strategies, that concurrent with our growth went through enormous growth on their part as well, and morphed into many different kind of financial and fintech verticals, one of which was private equity. And they were good owners. They had reasonable access to capital. As with most private equity-backed companies, we carried a hefty amount of leverage, typically 5.5 to more than 6 times leverage. But importantly, they backed the company during its formative years and a period of time where the world candidly was very challenged. If you think back to that time and everything that happened dynamically in the macro environment, you had firstly the failure of the nuclear renaissance that was talked about at the time to really take root, and that was based largely on a combination of competing technologies, a gas bubble, the heavy subsidization renewables, and really the failure of the reactor designers to essentially deliver on what they committed to at the time, which was inexpensive, rapidly built, standardized reactors overall. Following that, you had the financial crisis, global financial crisis in '07 that spawned the Great Recession that arguably lasted for 5+ years, beginning in '08. You had the Fukushima incident in 2010, which led to not only a Japanese reactor-based shutdown, but the shutdown of reactors in Germany. The Chinese went pencils down on new build activity for a couple of years and fundamentally changed their stance on nuclear industry. You had another recession. You had energy prices that were incredibly low because of, again, the just prevalence of seemingly unlimited shale gas, build out of combined cycle gas turbine power plants, et cetera, so that most of the nuclear power plant operators globally were losing money. And despite all of that, we grew. We grew for our first 15 years during that that parade of horribles at a top line rate of CAGR of about 12 points for organic, 8 inorganic. We delivered a multiple of cash, a cash on cash return to our first sponsor of nearly 7 times, which you guys understand is an absolute home run by private equity standards, and spawned the way for essentially a buyout by Charterhouse Capital Partners, a very highly regarded, longstanding, iconic private equity fund or firm in the UK. Charterhouse was very helpful in not only providing arguably a larger war chest for M&A, during their hold period. We did more than 15 M&A deals, and they in particular were very helpful in helping us to navigate some of the political intricacies of deals in Europe, which is really their forte. And again, it was a very beneficial kind of symbiotic relationship with them, but they deployed a lot of capital really right up through the end of their hold period, which was extraordinary, given the fact that they had invested in us through their 9th fund, which at the time of their exit was nearly a decade old. And yet they still continue to provide capital for large deals that really helped shape the transformation of the business and my diversification more broadly into medical. As you noted, Charterhouse came out, took the majority of their money off the table when we IPO'd with the backing of Goldman Sachs. Noting that Goldman Sachs did 2 SPAC deals. One was a company called Vertiv, and the other was us. And we went out at the time that the SPAC market was really beginning to, maybe just to put it bluntly, collapse. And we were able to go out and raise an extraordinarily large pipe, get the offering done with minimal redemptions in the trust fund. American Capital or Charterhouse Capital was able to get the majority of their capital off the table the day of the offering in October of 2021. And ultimately, they earned a multiple of cash of roughly 2.5 times, which again during that hold period was represented significant value creation. And we took the company public and have gone through the learning curve, all that goes with that, and kind of the new rules of engagement as it relates to leverage and the way we think about capital allocation and a whole host of other factors. But again, that's kind of the financial history of the company at a very high level.
There's a lot of interesting history there, but I did want to go back to some of your comments with your first sponsor and the leverage levels. And you did mention that there's new rules of engagement with regards to leverage, but being at 5 to 6 times leverage, that's pretty typical for private equity. But what was atypical was your growth levels, as private equity backed firms or companies typically aren't seeing that type of growth. Can you talk a little bit about what that leverage did to operate from an operator standpoint and operating efficiently because of those constraints into being able to grow at such high levels, and how
Sure.
that has kind of followed through into today?
Yeah. So the interesting thing, Michael, is that given the history of the company, we just thought that was normal to carry that level of leverage. We really thought nothing of it. And again, if you think of the macro environment that I articulated earlier, and notably, one of the things I failed to mention was that the two leading firms in the nuclear industry, Westinghouse and the state-owned French company Areva, both went bankrupt during that period of time because of financial stress. And yet, remarkably, we continue to grow in a very acyclical fashion at an organic growth rate. Again, a 15-year CAGR of 4 points, which was the envy of most industrial tech players, certainly all of the nuclear players, and added 8 points of inorganic growth CAGR to that as well. The secret to all of that, again, kind of comes back to a combination of multiple factors. It's the technological leverage that I noted before. But beyond that, we enjoyed and continue to enjoy a network effect. This is something that's commonly talked about in Silicon Valley, relating to the tech sector, less discussed or less often discussed in the industrial technology space, but it's equally relevant. And the fundamentals are that the value of any network are a combination of the number of points of presence and the content that is pushed through that network. And in our case, then and now, we enjoyed the largest global network. So our biggest competitors are companies like Ametek and Fortive and Thermo Fisher. But on a like-for-like basis, we are many multiples their scale. And so that scale translates, again, into a global network, global presence that is more comprehensive than our competitors, large and small. But also, given the scale of what we do, we have the most content that we can push through that network. And so what that's allowed us to do is to basically spin up a flywheel, where over the years, as we've gained strength, we've continued to invest heavily in innovation. We spend about 10% of our revenue on hardware engineering every year, a substantial amount. In addition to that, on software engineering and development. And that allows us to be one of the leading innovators in the field. Today, again, we are the number one global player in the vast majority of our vertical markets. And the inherent nature of the markets we serve is that they tend to be acyclical. But beyond that, there's kind of a negative covariance of demand between the medical sector and the industrial or nuclear power sector, which gives us further diversification. So all of those factors have allowed us essentially to outgrow our markets for the majority or arguably the entirety of our history. And we've done so in the main, by extending our global reach. So noting that even though we may be the global leader in a specific product category, generally speaking, that share position is uneven geographically. So as an example, we may dominate the US market, but have a minimal share position in Asia Pacific and a moderate share position in the European footprint. But as we grow, as we scale, as we standardize, it gives us the ability to really focus on those areas where our share position is uneven, to bring it up to where we think we've earned the right for it to be. And this, simplistically, is what's allowed us to historically outgrow our markets.
Now, getting into the fundamentals, I did want to approach the thesis for investors behind the company first from a macro top-down perspective, and one of the drivers of growth from a more macroeconomic perspective is just this nuclear renaissance and the growth of the nuclear industry. Could you walk us through the bull case of where you see the industry heading?
Sure, of course. The industry is suddenly commanding a lot of attention, and really the catalyst for that is the activities of the hyperscalers. As we think about Microsoft, Alphabet, Amazon, Meta, etc., and they are effectively in a bit of an arms race right now to lock in carbon-free baseload power at predictable prices. This is an essential catalyst of their AI-driven business models and their commitment to be carbon-free consumers of electricity by 2030. And so nuclear power for them is the answer. A few weeks ago, kind of maybe the thing that more than any other factor has brought nuclear into the consciousness of mainstream investors was the extraordinary deal between Microsoft and Constellation Energy to bring back to life the 3 Mile Island power plant. And Microsoft agreed to take 100% of the output of that nuclear power station for a 20-year deal at rates that are substantially above the prevailing PJM rates. And PJM is the energy exchange where TMI, 3 Mile Island, sells its power. And that was, again, kind of a reflection of the strategic value of that deal to Microsoft. And in the wake of that, we've seen a number of other deals that have come out between Google and Kairos, Amazon and X Energy, Amazon and Talon Energy, and others. And we think this will continue. The level of engagement with the hyperscalers globally, with producers of nuclear power, continues. And this is simply the latest call on energy. But the fundamentals are candidly much deeper than that in terms of what's driving nuclear power. The simplest way you can state it is that there's simply not enough electrical generating capacity in the world. And the world has a concurrent desire to decarbonize the global economy, as reflected, most recently by the UN COP conference earlier this year, which called for a tripling of nuclear generating capacity by 2050. Again, an extraordinary policy position by a group of environmentalists that historically have been anti-nuclear, just reflecting how important nuclear now is to solving the world's energy problems overall. But there have been issues on both the supply and demand side that have changed markedly over the years. Certainly from a demand standpoint, hyperscalers are top of mind. But more generally, since the global recovery post-pandemic and really preceding that as the world recovered from the Great Recession, we've seen a stronger global economy. And you've seen a number of other kind of major factors that have supported this. One is the emergence of the EV economy, the electric vehicle economy, the general trend toward electrification of global or of developing economies. So as economies develop, as they emerge, you see a shift in energy consumption from fossil fuels toward a greater consumption of electrical demand, and certainly that's happening in the developing part of the world. You've had Bitcoin miners and other factors as well that on the supply or on the demand side have driven, part of this disequilibrium right now in energy supply. On the supply side, you've had a change in natural gas supply where, while the U.S. continues to produce shale gas at a very high rate, the activity definitely cooled off. Part of that being driven by federal government policy decisions, part of it driven by interest rates, where, when the helicopter money ended and the Fed went from a zero interest rate policy stance to a much more conservative stance, driving up the breadth of the yield curve, that put a lot of wildcatters out of business, limited access to capital for others. So you had that. You had the cessation of Russian gas supply into Europe, the liquefaction of larger content of American gas for transshipment into both Europe and Asia. and other factors, which again, on a supply side, affected the equilibrium. The bottom line is that through a combination of economics, macroeconomics, again, supply and demand, and government policy, which has become really apolitical, meaning that this nuclear renaissance is supported by the global right, the global left really spans the political spectrum. And you're seeing activity beyond, what I noted about the UN at the federal and state level in the U.S., with many billions of dollars of federal government support for the nuclear industry. But that was preceded by state level support that ironically began in New York State when they passed legislation supporting zero power emissions. So a combination of all of those factors is really what has caught the attention of the investment community, and creating a recognition that in many respects nuclear power is now a secondary play on AI, and recognizing that all of the primary investment themes and conduits to gain exposure to AI have long since been exhausted. Nuclear is really just kind of moving into that rotation, and more investors are understanding that this is a long-term play on a world that fundamentally is changing.
Now, taking those macro tailwinds and translating them into, how that helps Mirion Technologies, specifically the two verticals, nuclear tech and medicine, where do you specifically, Tom, see growth opportunities over the next couple of years?
Yeah, for us, the biggest and most immediate opportunity in nuclear, and I'll touch on medical in a moment, but in nuclear, it's the installed base. The installed base accounts for about 75% of our nuclear power related revenue, and it's very predictable, very visible in nature. In general, at a consolidated level, about more than 70% of Mirion's revenue is recurring or repeat in nature, and it's a function of our business model, where once we gain a position of incumbency with a client, whether it's a nuclear power plant, a medical facility, a government installation, that position tends to be very defensible. The competitive mode is deep and it's broad. And so that allows us to enjoy a downstream tail of, again, recurring and repeat revenue that in the case of the nuclear industry can literally last for a century, which is mind-boggling, from a planning standpoint. But because the world today has about 440 operating nuclear reactors, and we have a position in more than 90% of those, it gives us the ability to aggregate demand patterns and understand well how, as those reactors age, how demographically that will inform demand patterns. And that is a starting point in terms of how we think about recurring revenue. But as we have seen energy prices, electrical energy prices tick up, as we've seen the operators of nuclear power plants go from being unprofitable a decade ago to being extremely profitable today, it's created a very powerful incentive for those operators to want to run their plants hotter, meaning at higher capacity factors, which is the term of art for capacity utilization in the industry, to run them longer by getting permitted life extensions. So as an example, most of the American nuclear power plants have been life extended originally from a 40-year life to 60, and now we're beginning to see the leading wave of permit extensions for 80 years. And again, there will be some that will operate for a century. And then thirdly, through uprates to capacity, spending money on infrastructure that will enable them to garner more output out of a specific plant. All of those factors ultimately create a tailwind for us, meaning that if operators are running their plants hotter, longer, and at higher output, they tend to buy more capital equipment, more services, and invest in more software revenue with us overall. And that really is the demand driver of our activity in the nuclear industry in the main. And the great thing about that is that this is not something that will happen a decade from now and is contingent upon the build out of new plants. Again, this comes from the installed base. But on top of that, you have two other factors. One is the build out rate of new nuclear power plants, where globally, there's something, the exact number escapes me, but something on the order of 50 new reactors under construction globally. And there's tremendous activity around the world for new build activity that we expect that over a long horizon will accelerate for utility scale nuclear. And certainly this is what the policymakers have called for and what the reactor designers, the so-called NSSS firms, are focused on. The final piece of the puzzle is the small modular reactor movement, which is, of perhaps the greatest interest to the hyperscalers that we talked about before. These are either downsized version of third generation reactor technology, typically light water reactors, or fourth generation technologies that are different in how they operate. And that would include, sodium cooled molten salt reactors, pebble bed reactors, and things like that. And the focus of the SMRs initially had been on decommissioned coal plants. So a coal plant that has 300 megawatts of output cannot be replaced by a 1 to 1.4 gigawatt utility scale reactor. There's not enough real estate around it for an appropriate exclusionary zone. The grid infrastructure won't support it, et cetera. But you can drop in a small modular reactor, and the existing infrastructure will support that just fine. And if you look at the American market alone, understanding that this is a global opportunity, there's something on the order of 60 gigawatts of scheduled coal plant decommissionings over the coming years. And that really has been historically and initially the primary focus of the SMR players. But now on top of that, again, you have the hyperscalers that are stepping in and in kind of a risk-on fashion, really embracing, in particular, these Gen 4 designs to meet their specific objectives. So the SMR build-out, which we still see as being more of a, even though we've booked well over 10 million in backlog, and we're working very closely to forge strategic alliances with all of the leading SMR players, we still see the mainstream revenue from this particular segment as being, kind of a 2030 and beyond phenomenon for us overall. But, again, the good news is that with the core health of the installed base, the existing activity with utility scale nuclear build-out activity, our nuclear business today is healthier than it ever has been.
Thanks for sharing that. And there's a lot of features of the Mirion Technologies story that I really like. I like how you guys sort of grew under private equity ownership. That provides a really solid base, like the acyclical nature of the business model. I love the fact that you guys went public several years ago and sort of caught this nuclear renaissance wave, because as you indicated, there's a lot of investors looking for sort of AI derivative plays and view nuclear as one way to do that, capitalizing on growth of the hyperscalers, SMRs, themes that investors are really thinking about these days. So it seems like you guys, or specifically you, Tom, went from a 2 to 3 year flip to a 21 plus year story that has a lot of potential here. So thank you for sharing the story with us. Prior to letting you go, I did want to ask, as a long-tenured CEO, decades of wisdom and experience, what advice would you give your younger self?
Yeah, that's a tough one, Julian. I would go with all of the the usual pablum about working hard, have an agenda, understand finance, the lingua franca of the business world, as a primary, not a secondary language. But beyond that, I think the things that matter more, particularly for people that are early in their career and have great ambitions, is to ask for help, ask for mentoring. Periodically I will be asked by some young stud puppy within our organization for career guidance, and I always take the time to give it and to follow up, and it causes me to essentially develop a relationship with that individual, and it's more powerful than people understand. Be assertive. Understand that if you don't fail ever, you're not trying hard enough, and that all the really lasting lessons we learn in life come from failures, not from success. And to understand that, embrace it, expect it, learn to be a great communicator, learn to be authentic. All of those things I think are important for anybody that, is aspiring to doing something big.
Well, great. Thank you for sharing your wisdom and experience with us. Don't be afraid to fail, be assertive, and seek mentoring. Really appreciate that. And thank you for sharing the Mirion technology story. Pretty fascinating stuff.
Julie and Mike, it's been a pleasure speaking to you today.
All right. Thanks, Tom. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.